Before we get into today's video, some regulatory compliance. My name is Andrew Alexander. I am Head of Investments for Three Counties, an independent financial advisor based in County Durham, England. This video is for anyone who has an interest in investing and investment markets, both retail clients with no experience of investing through to industry professionals who invest for themselves and their clients. As independent financial advisors and wealth managers, there is no commercial relationship between ourselves and today's guest. The purpose of this video is educational, and in no way should any of the content be construed as advice, nor is it an enticement to invest. Past performance is not a guide to future performance, nor a reliable indicator of future results or performance. The value of investments may go down as well as up and is not guaranteed. Therefore, investors may not get back the amount originally invested. And now, onto the video. Welcome everyone to another of our weekly investment manager videos, and many thanks once again for tuning in. Video number 5 in our end of 2021 market roundup and an outlook into 2022. Today we discuss the one area where everyone has questions about: emerging market economies. Will 2022 herald a return to form for the global growth powerhouses, or will they struggle under the weight of global supply chain pressures and COVID variants? And who better to give opinion on this than Charlie Bond, manager of the Invesco Global Emerging Markets Fund. But first, as ever, before we get into the content, and remember, it's Christmas, it's a season of goodwill. If you haven't subscribed already, please do. It will be wonderful if you do, and it does really provide us with a whole lot of support to enable us to develop this channel and bring all the content to you on a weekly basis. So, festive begging, I suppose, over. Charlie, many thanks once again for coming onto the channel. The last year has been very interesting for various reasons. Looking at emerging market economies, how's the last 12 months been, and has there been much variance across the region?
Yeah, well, 2021 has been a volatile year. Inevitably, there's been, recovery has been the main theme, I would say. 2020 was such a bad year for economies, for reasons we all know. Inevitably, 2021 was going to be a year of recovery. I'd say also there's been, it's been truncated by continued COVID interruptions. So there's been lockdowns in places. Indonesia had a lockdown over the summer, and places haven't been able to shake off the pandemic, as we know, with the Omicron variant sort of haunting us today. So it has been a year of big variance. As you said, there's been global supply chain shortages in, I'm thinking, semiconductor space, but also bottlenecks in commodity areas, and that's led to some big beneficiaries. So North Asia, for example, has benefited from supply chain disruption, semiconductor side, we would say, but also commodity producers like Russia benefited from higher prices of natural gas, for example. So places like that have always had a tailwind from some of the disruptions. Other places have not had so much luck. Places like Thailand, obviously, which is heavily dependent on tourism still, not seeing a return to normal, and so economic growth there has remained, very lackluster, frankly. And I'd say also there's been some domestic policy decisions that have weighed on growth in certain places. In particular, I'd say China. We've seen a lot of regulation on technology, but also on the property market, and also on emitting sectors, so curtailments of steel production, for example, for environmental reasons. And all of these things have been depressive for growth in China. So there's been a wide variance of growth outcomes this year. It's been a volatile equity market, but I think that broadly speaking, 2022 is likely to see a sort of a gradual return to normal, in terms of how countries respond to the pandemic. So we're hopeful, but as ever, we don't want to get sort of too ahead of ourselves.
Yeah. Moving into outlook for 22, could it be more of the? Well, I suppose it could be more of the same. But have we seen the worst of it behind us? Do you feel?
Well, I think that COVID, for example, is going to become a lesser impact on markets. It's not going to drive markets in the way that it has. And the reason for that is that I don't think governments have got the support to respond in the way that they did in the past. Yeah. I think lockdowns were popular before, but I think that now with vaccination rates rising, lockdowns are increasingly unpopular. Yeah. And so the economic impact of a spike in COVID cases is likely to be less severe because governments will take a more growth-friendly view or a more growth-friendly approach. At least that's our hope for 2022.
Yeah, is in obviously inflation in developed markets. It's everyone's talking about it. The tapering of central bank intervention as well. Is that going to be as great an effect on emerging markets as well? You know, is it the same? Do you need to have the same considerations as you do in those economies than you do in developed markets?
Yeah, I mean, I should heavily caveat the comments I'm about to make with, you know, we don't spend a huge amount of time thinking about broad inflation. You know, we're bottom up investors, and of course we try and think about inflation when we're doing our stock analysis. But you know, the extent to which we are looking at inflation trends globally and analysing the impact on the portfolio, that's not something where we have a huge advantage, we don't think. But I think you're right. I think central banks have become more hawkish generally, and that's because they have expanded their balance sheets massively, and they've got an eye on the potential impacts of that. But in emerging markets, you know, inflation is not something that's new. This has been around for a long time, and most of these economies are sort of used to dealing with it. So I think that a lot of the inflationary pressures that are being experienced are as a result of higher commodity prices and bottlenecks. I think a lot of those are going to get resolved in 2022, and so that will have a disinflationary impact on some of these places. Yeah. Also, quite a lot of economies have already raised interest rates. So, you know, Brazil, Mexico, Russia have all hiked interest rates quite aggressively. You know, quite hawkish and responses from the central banks there, and that's inevitably going to lead to a less inflationary environment. Yeah. So we're not totally panicked about inflation. We think it's a course, you know, normal course of business for all of these places. Again, the main place I'd highlight as being an exception to this is China. You know, China is already experiencing, you know, disinflationary pressures from the property market, from you know, as I mentioned before, reductions in output of certain commodities like steel. And so China's in a slightly different cycle to other parts of emerging markets, and definitely in a different cycle to the US, I would say. So I think the disinflationary impact of China is something that we need to keep in mind when we think about 2022, you know, globally, but also within emerging markets.
Taking it back to the fund, like you say, bottom-up stock pickers. First of all, have you had much change over the last 12 months? Have you need to change the portfolio much? And then also looking into 2022, you know, is there anything that's exciting you, both name-wise and region-wise?
Yeah, I mean, the biggest change in the portfolio that happened, you know, again to point out, turnover is typically pretty low. You know, we've got a 3 to 5 year holding period. Yeah. But the biggest change was in the first probably quarter of the year. Technology stocks, particularly in Asia, performed very, very well, and we were quite aggressive at rotating out of those names. We rotated into some of our cyclical holdings. But we also bought new names. We bought a number of new defensive names, and so, you know, today the fund is meaningfully overweight consumer staples, and we're also overweight telecommunications. These were not well represented in the fund at the beginning of the year, but we've bought what we think are pretty cheap stocks, that some of which benefit from gradual reopening, but others, frankly, move to a totally different beat. So these defensive areas have grown in the fund over the last, over the last 9 months, and that's been right this year, given that technology has sort of started to underperform quite meaningfully in the second half. So I'd say that's the biggest thing we've done in the fund. In terms of places where we're looking today, it's as you'd expect in places that are doing badly. So we've been working on Brazil. Brazil's been a very poor market this year, and there are starting to be some opportunities there, we think, especially in some of the more cyclical areas. So we've been looking at some of the property companies there. We haven't bought anything new, but we're excited when we see large price declines, because we start to think that that's where pessimism has become overly priced in. So Brazil is an area we've been adding to, or we're looking to add to, rather.
Yeah, and I like when anyone uses the word excited. I think at this moment in time, with the malaise of doom and gloom that seems to be layering upon us all, both within the markets and then out within our daily lives, the word excitement is something that I'm personally going to hang upon as much as I possibly can.
Well, I mean, I think as sort of contrarians, the thing that makes us excited is pessimism. It's a bit of a sort of doom-mongers approach, I suppose, but we're looking for situations where people are selling at unreasonable prices, where they're capitulating. That's what we're looking to take advantage of, and that gets us excited. And I'd say that there are parts of emerging markets that look very cheap. When I look at our portfolio, it trades at a big discount to emerging markets more broadly, and emerging markets broadly trade at a big discount to developed markets. I don't feel like valuations are going to be the banana skin in 2022. There'll probably be another banana skin, but I don't feel like it's valuations.
Yeah, there's one thing you can guarantee with emerging markets: there's going to be plenty of banana skins, but also the opportunity that you have there to look at this huge palette of opportunities and actively select and buy on capitulation is, it's something that's investing. It's about making money. It's about buying low, selling high, and a lot of people have forgotten about that over the years. Maybe now's the time to actually start thinking about that and considering valuations more and more. Charlie, as ever, mate, it's magic to speak to you. We're coming up to Christmas, so this will probably be out closer to Christmas. Should have put my Christmas jumper on anyway, but never mind. Thank you once again for all your support this year, for your management of the portfolios, and you have a great Christmas period and New Year. We'll catch up. We'll catch up in 22. But you stay safe, and speak to you later on.
Thanks very much, Andrew.